Hello, guys, welcome back to my YouTube channel. I'm really excited today to make another video for you guys. So, today we will be talking about the pros and cons of trading options before earnings report. So, before we start, what is an earnings report? An earnings report is a quarterly filing of a publicly traded company where it reports its profits, progress, and expectations for the future. An earnings report can either be positive, that is, the company makes a lot of money, or negative, that is, the company loses money. In the world of the financial market, an earnings report can increase the stock of a company really high or decrease the stock of a company really low. For example, let's look at the stock called UAA. UAA was trading at $20 before earnings, but after earnings, the stock decreased to $16. That's about a 20% decrease. So as you can see, earnings can be volatile for stocks. So before trading options, you need to know the pros and cons related to trading options before earnings. The first con of trading options before earnings is that you should assume that you're going to lose money. As traders, we do not know if the price of a stock will go up or go down. Even if a company reports a good earnings, a stock can still fall. However, a company that reports a really terrible earnings can still see an uprise in the stock. So it will be rational to assume that you're going to make money when you trade options before earnings, because we do not know where the price will go after earnings. So by thinking that you would lose money when you trade options before earnings will make you to risk a lower amount of your account, so that in the situation that you lose money, you do not blow your account. So the second con of trading option is that trading options before earnings is a gamble. It does not matter what strategy you do. A gamble is a gamble. So let's look at the meaning of what a gamble is. So from Google, a gamble is just taking risk of either losing money in return or making a lot of money. So when you trade options, what happens the next day? The stock either rises or falls. So depending on the strategy you use, if the stock goes in your way, you make money. But if the stock goes against you, you lose money. So trading options before earnings is a gamble. And the third con of trading options before earnings is that the value of an option contract is inflated before earnings. This means that the value of an option contract is higher than what it should be. This is due to the uncertainty during earnings, since the stock of the company can rise or fall substantially. So the market makers are responsible for selling and buying option contracts from traders. And if earnings is coming up in like few days, the market makers will want to reduce their risk of losing money by increasing the price of the option contract. So when the market makers increase the price becomes inflated, and when option buyers go buy those options, they can either lose or make money. After earnings, the value of an option returns to the normal price. So when the value of an option returns to the normal price, the reduction can either make an option seller a lot of money or an option seller to lose a lot of money. Also, the reduction can make an option buyer, depending on the stock movement, can make an option buyer a lot of money too. So it depends on where the stock goes. But the option value always decreases after earnings. So you should note that the value of an option contract is inflated before earnings. However, after earnings, the value of the option contract will reduce to the normal notional value. So now that you know the cons of trading options before earnings, what are some pros or advantages of trading options before earnings? So honestly, there are not a lot of pros or advantages of trading options before earnings, but there are some few things I can think of. So the first thing is trading options before earnings is less risky if you trade with a proper size. So if you look at the value of an option compared to the stock, sometimes the value of an option is less risky because you're controlling 100 shares of a security at a lower price. But if you were to buy 100 shares of a stock, that will be more expensive and really risky, especially when you trade before earnings. So like buying or selling options before earnings is less risky than buying or selling the stock. The second advantages of trading options is that you can make a huge amount of money. Options are really risky because they're derivatives of stocks. So if a stock moves like 1%, an option contract can move like 10 to 20%. Especially during earnings, an option contract moves hugely. It can move from 100% to 1,000%. So an option buyer can make a lot of money. However, the same option buyer can lose the whole amount of money if the stock goes against them. So you should know that you can make a lot of money trading options, but also you can lose a lot of money trading options. Now that you know the pros and cons of trading options, I hope you guys enjoyed the video. I want you guys to like, subscribe, and comment below. And if you have any questions, please kindly ask your questions because I'm ready to go in and research to answer any questions. Please like, subscribe, and comment below.